reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses.
Daddy, chill.
What the hell?
Wall Street ended the week with its worst day in months. The Dow Jones fell more than 1,000 points. All three major indexes were off more than 3%. The sell-off began after Fed Chair Jerome Powell delivered a stark warning about the future of interest rates. Here is CBS's Nikki Battiste.
The pain on Wall Street was felt tonight after this blunt assessment from the Fed Chair Jerome Powell.
While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain.
What did I tell you? You don't buy anything, you hear me? Don't buy anything. I'm sorry.
All right. Today is Monday, the 29th of August, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. What's going on? Why are you acting all weird? Oh, right. I was away for 2 weeks, and all of a sudden, all hell breaks loose. Did I miss out on anything here? Did I miss on something besides Sly getting dumped by his wife for choosing a dog over her? Leave the wife, keep the dog. That's the ultimate margin call, though. The guy has a net worth of over $400 million. That's going to be cut in half. So let's say $200 million. That makes the dog the most expensive dog in history. But maybe he's going to sell it for more at some point. Who knows? Maybe he can sell it as an NFT at some point. Most expensive dog on the planet. Maybe that's a better investment than the stock market, right? You wanted to fight Papa Jerome to the moon, bro. The Fed's going to pivot. What do you know? Papa Jerome whacked your little head with the hammer. And here we are. Folks, we're going to talk about all of that and a lot more because there was a lot of bullshit happening when I was away. For 2 weeks, I had to reflect and watch TV and listen to everybody else. And it's complete garbage. So I'm going to sort everything out for you using the details, the facts, and you're going to have a lot of clarity after watching this episode. But before we start, you might have noticed that before watching this video, you had to pay for a ticket, right? Welcome to the membership program. This is the first class, the VIP, forget about the economy, eating peanuts and all that bullshit. Here, we feed you popcorn as an NFT on the house. But really, what's up with the membership? What's going on here, Maverick? You see, I've been absent for about 2 weeks or so. And the reason is I got into a conflict with my employer. For those of you who don't know, I actually have a job. I do portfolio management, financial advice. I have a set of clients. I work for somebody. When the channel was small, there was a little bit of a problem, but so long as the channel was small and I wasn't using my real name and I wasn't using the company's name, everything was in the up and up. No problems at all. But then when my controversial, quote-unquote, opinions and views started to come out, I noticed a little bit of a problem. But now it got out of hand. The channel got way too big for them. And basically it is a violation of my contract. I'm not allowed to comment and talk about the stock market or give anything that is perceived as advice or direction or whatever regarding the stock market. In their view, if I'm going to have a YouTube channel, it has to follow their guidelines. I have to do it on their behalf, meaning no more calling JP Morgan a landromat, no more calling BlackRock thugs, no more calling Jerome Powell a criminal. It will become a really boring channel and I'll be completely restrained. This is not what I want to do. So this conflict came in a timely manner because to begin with, I've been already burnt out, exhausted, working from 5 in the morning all the way sometimes to 10, 10:30, sleep at midnight, wake up again at 5. This is not sustainable. On top of that, the videos come out late and we're missing out on growth from the East Coast viewers who get the videos the next day after midnight. This is just not sustainable. So what I'm doing right now is launching these membership tiers and hopefully we'll get a decent amount of viewers joining the membership program. And if I get that by November of this year, I'll be doing YouTube full time, working for me and for you. That's it. And everybody's going to benefit. For me, I get to have a little more time to produce more videos, to get them out a little earlier. You're going to get the benefits from the membership, but you keep this channel sustainable and you get to get the most out of it. But even for those who are not going to join the membership program, they're also going to benefit because they're going to see the videos earlier. So the East Coast viewers will get the videos in timely manner, and the channel will not miss out on growth opportunities. Now, here are the tiers that I have for you. The first class Maverick, that is $10 a month. And by the way, I would have done it as $10, but this is what YouTube does, the 99 bullshit. So it is what it is. For this tier, you're going to get the loyalty badges, the top Mav badge. You're going to get a bunch of emojis that we use in this channel all the time, such as the alright or the alright, depending on how you hear it. The Elmo with the fire, the always, the Pacino, and many more coming. And of course, folks, I'm not an artist here, so this is just a preliminary attempt. I'm going to hire somebody professional who's going to do it better, and you're going to like the final product. But most importantly, one video from this channel per week will be exclusive to the membership, so you're going to get access to that particular video. Only the members will have access to one video per week. I produce 5 videos a week, so 4 will be public for everybody. 1, I'm thinking the Sunday show, and I'm choosing the Sunday show because I have more time to work on it on Friday and Saturday, so I can do more in it. I can do more with options, I can do more with other ideas, and that show will be exclusive to you. Only you will have access to the Sunday show. Then if you have more means to support the channel, you got the VIP Maverick tier. That is $25 a month. You get the same perks from the first class Maverick, but you're also going to get the membership market chat. And the idea here is in November, if I do this full time, let's say during lunch break from 9 to 10 Pacific time, noon to 1 East Coast time, we're going to figure this out via Discord or whatever. We chat about the market, developments and the charts, trade ideas. We get to benefit from one another. Now, the highest tier is the Top Gun Maverick tier. For that, you get...
Take my wife, please.
The same perks from the previous 2 tiers, but you're also going to get your name displayed in the outro of each video. In the credits, you're going to see your name rolling as a co-creator, producer of these videos. You will also get the opportunity of calling me in my upcoming podcast in 2023. So again, all of this effort is not going to go just in my pocket and to help me quit my job. This is going to go into expanding the channel, producing a podcast, hiring folks, building a studio, etc., etc. But you're also going to get the options trade reviews. And the idea here is if you have an option trade that you just entered or you're thinking about, you can send me that idea and I will produce a special video per week for this tier only, where I'm going to go over at least 10 trade ideas, reviewing those, suggesting entry, exit strategies, how to manage them, how to reduce the risk, etc., etc. And we rank these trades. And it's up to you if you want to follow them or not. And then we give you an update the next week and review more trades. But depending on how many members we're going to get in this tier, it's going to be first come, first serve. So those who subscribe now get the priority over those who are going to subscribe in December, for example. And look, folks, at the end of the day, these are just perks that I throw at you. But your real motivation from joining any of these tiers in the membership program should be, look, I like the son of a bitch, I want him to be independent, and I want the most out of him, and I'd like to support him. But for those of you who are going to join the membership program thinking that I'm going to spit a bunch of tickers, hey, today we're buying calls on this, tomorrow we're buying puts on that, this is not for you. I don't do that at all. There's TikTok for that. This is to support the channel, to keep it independent, and keep it going. I've been doing videos, hourly videos, even when 300 people were watching. It didn't matter to me. I refused to pump the meme stock mania, even though I could have achieved a lot of growth. I could have pumped cryptos and SPACs and garbage, achieved easy growth. I could have promoted all of these trading applications, some from China. I made a lot of money. All these crypto ads, all the people who reached out to me, hey, can you pump this? Can you promote that? I refused to do all of that because it's not right. It doesn't serve the audience I'm trying to target here. So this is the best idea to keep the channel independent, for me to work for you and not for anybody else. And of course, there are a lot of traders, the apes and the likes, who watch the channel, yet they shit on it all the time, even though I'm looking out for them. The beauty of this is, hey, you want to know what's going on with the stock market?
You pay me.
You want to know which one is going to go to zero first, AMC or ape?
You pay me.
You want to know when pounce?
You pay me.
You want to know which one is going to be bigger today, the left nut or the right?
You pay me.
But seriously, everybody's going to benefit from this. I will benefit from becoming a full-time YouTuber. You will benefit from exclusive content and more from me. And even the non-members will benefit from getting the videos in a timely manner. The last thing I want to talk about is why YouTube versus Patreon versus something else. I think by now you know that I have a little bit of wisdom. So all what I'm going to say right now is trust my wisdom in this one.
I have a plan.
Without further ado, enough with the begging. Let's move on and talk about the market and what's going on in the economy. And here it is, in focus tonight. Welcome to the House of Pain, courtesy of Papa Jerome Powell. You see, JP promised us pain. He said we're going to have some pain. And he did not just say pain in the stock market. He said pain in the economy, in the employment picture. For households, we're all going to experience pain. Now, you think we're going to experience pain in a soft landing or in a booming economy? Or is it going to be pain because of a recession, perhaps a deep one, that nobody seems to really see or forecast for now? Even those who say, yes, we're going to head into a recession because the economic cycle says so, they're also nervous. They're not going to tell you that, but they're nervous. Why? Because they see the employment, the jobs market doing so hot. And they say, oh, maybe the soft landing is going to happen after all. I'm going to expose all of that for you using the facts, the logic, and the details. But remember this, when we talk about the stock market, we said don't fight the Fed. Don't fight the Fed, because you're going to find out the hard way that fighting the Fed is not a good strategy. We said that last time around. You want to fight again with Jerome Powell, he's going to knock you out. He has bigger guns than you have. And for the arrogance of people to think that the Fed is going to do this or that or pivot because of one reading of the CPI that went down because oil futures were down for a month is premature in nature. A lot of these folks are finding out that they got it wrong the hard way. And indeed, we're going to have more pain to come. And it seems that the Fed is all of a sudden in consensus that they want to tackle this inflation even if it causes a recession. Now, is that a bluff? I'm not going to bet that it is a bluff. And those who bet that it is a bluff are experiencing a lot of pain in the market. I'll explain to you why. Spoiler alert, the Fed is not in control. The Fed is being guided by the economic cycle. I'm going to explain that in details to you in a minute. But listen, for example, to Fed zombie from Richmond, Tom Barkin. And Mr. Barkin says that the central bank was resolved to curb red-hot inflation and that there is a risk that the efforts could cause an economic recession. What happened to the soft landing, Barkin? Better yet, what happened to transitory inflation? This is the same guy who said last year that by late 2021, we will see inflation easing. How did that go? These are the same clowns, by the way, who kept saying inflation is going to be transitory. So I understand why we have a degree of skepticism when they say we're serious about fighting inflation. A lot of market participants say, no, you're not. Why? Because they have established this reputation of being wrong all the time and playing poker. They're shitty poker players, by the way, bluffing, pivoting, flip-flopping. Last year, on May 13th, 2021. Listen to this. It reads, acceleration in U.S. price growth this year will have only transitory effects on underlying inflation, said Vice Chair Richard Clarida. Remember that one? The insider trading, Clarida, who got caught and decided to retire to evade any punishment. But we also got Governor Braindead, who's a vice chair now, and she said that everybody should be patient through the transitory surge in inflation, okay? The policymakers expect the Fed's preferred measure of inflation to rise to around 2.4% this year. This is 2021, by the way. As the economy reopens and the pandemic recedes, they forecast it to return to their 2% goal for 2022. All I have to say is good luck. And they gave us 6 reasons why inflation will go down to 2% on its own magically. Among those reasons, disruptive technology. Listen to this. This is the same Barkin, by the way. A number of structural factors have led to global disinflation over the past 3 decades. These include globalization, which has given cheaper access to supplies and labor from around the world. Slowing growth and aging of the population will reduce demand over time. Remember the demographics. The demographics. That's what's going to take inflation down. Anyways, and advances in technology and the internet, those forces are likely to keep pushing against higher price pressures. You have disinflationary forces that are tough to break, said Tom Barkin, zombie from the Fed. I love to buy books, but when I go to Barnes and Noble, and I see a book that is at $30, I go to my phone. If the book is at $14.99, I press bought. Wait a minute, you press buy, you stupid By the way, this is a Fed president who probably has a PhD, he gets paid, I don't know, hundreds of thousands of dollars, millions, and this is the way he thinks about inflation? A frat boy could have thought the same way. Oh, I can buy the book at a cheaper price from the Fed. There's no inflation. These are your beloved and trusted Fed officials. They have absolutely no clue what they're doing at all. No wonder why the economy is collapsing. And it's in a mess, but it gets better. You see, the dip buyers, the bulls, the apes, the monkeys, the whatever you want to call them, doesn't matter to me, were chasing the rally, the fake rally that they fed them, the trap. They decided to ignore a lot of warnings, and they got fixated in a tunnel vision kind of way on certain indicators, such as technicals, but sentiment indicators. They looked at the pessimism, for example, in the stock market, and indeed, it did reach an extreme reading. But is that a good enough of a reason to assume that the worst is behind us and the bottom is in and higher we go to make all-time highs? And let's pile in. The simple answer is absolutely not, because last time we got such depressed reading, it was back in October of 2008. And if you did buy the stock market back then, you know what happened after that. The so-called sentiment improved as the stock market was crashing. So a lot of these indicators are good in measuring the pulse of sentiment in the market, but they're not really that good in timing the market or being used in determining tops and bottoms. This is not a proper use to these sentiment indicators. But let's be real here. What was the real reason behind the summer rally that we just got, and perhaps it has already come to an end? The answer is market participants assuming that because of gasoline and oil futures moving down significantly for 1 month, and because the CPI reading went down for 1 month, that we now have peak inflation, and inflation is going to go down. So regardless of what the Fed says, they're just putting an act. They're being hawkish to play psychology. But in reality, they're going to start cutting rates at some point, perhaps soon, because inflation is moving down on its own and the labor market remains hot. This is the soft landing, according to those who bought the rip. They priced in interest rate cuts by the Fed. Nobody in the Fed talked about cuts at all. They piled in buying single stock options. We saw an extreme spike in a short amount of time in buying call options. They stampeded on meme stocks, of all things, creating a mini mania, a pump and dump scheme that hurt a lot of investors. But their mistake is they eased financial conditions in doing so. And this is a major mistake, because the entire purpose behind increasing interest rates and unloading the balance sheet is to tighten financial conditions to take inflation down, to reduce the demand in the economy. That is the essence behind the Fed's strategy right now. So when we have a mini mania in the stock market that eases financial conditions, the Fed has to come out with clarity and put a stop to that in the most aggressive fashion, because market participants were destroying what the Fed was trying to build, which is tightening of financial conditioning to ease inflation. And the fact that we got a stampede in meme stocks, of all things, is an indicator that we still have excess liquidity in the system. We still have excess speculation in the system, meaning the job is not done, not even close. The bulls, or in this case, the pigs, they're not really bulls, the pigs, they decided to ignore all of the warnings that were right in front of them in clear daylight. For example, the tsunami of earnings downgrades, that was ignored. Even the Fed minutes was hawkish. That was ignored. The fact that even after the CPI came out and the stock market blasted higher, the bond market reacted differently. The yield in the 2-year shot up higher. Once again, that was ignored by the stock market. We got warnings from UBS that this is a dead cat bounce. That was ignored. We got a warning from BlackRock. I'd say they know a thing or two about the stock market. That was ignored. We got warnings from the likes of Rubini, for example, who said that it is delusional for market participants to assume that the Fed will pivot anytime soon. That was ignored. Even top propagandists for the government and the administration, the likes of Jeffrey Sachs, he came out and said that the Fed will keep raising interest rates, and rates will stay high for a long time because inflation will stay high for a long time. Goldman Sachs came with a warning, saying that the Fed is very resistant to interest rate cuts, and it could be years before they come down. That was ignored. JP Morgan, even JP Morgan, the perma-pumpers at JP Morgan came out and said, we got a survey, and the institutional investors, the smart money, are looking to dump stocks after the summer rally. That was ignored. One of the top technicians in the market, Katie Stockton, she also came out multiple times on CNBC and said that this is going to be a bear market rally and down we go. That was ignored. And the buyers of the rip, the formal crowd, ignored all of these warnings and decided to concentrate on the perma-pumpers. who've been proven wrong over and over and over and over again. The likes of fund star Tom Lee, your favorite analyst, who suggested that by the end of the year, the S&P 500 will be at all-time highs. And they decided to stampede on meme stocks of all things. And how did the meme stock mania pump and dump end? Well, in Bed Bath & Beyond alone, retail investors lost $205 million in a couple of days? On the other hand, the pumper and dumper, Ryan Cohen, walked out with over $65 million in profits. But the question is, did the market hear the Fed's message loud and clear, or are they going to fight them once again? Now, to answer this question, we need to understand the cycle of a bear market rally. Why do bear market rallies happen, and why are they so extreme? The answer is simply we have 4 stages of a bear market rally, and if all 4 are met, we get the most intense bear market rally, just like we saw this summer. And back in 2000, we got massive intense rallies because all 4 participants did what they do in a bear market rally. What am I talking about? Here it is. What happens when you have a catalyst such as oil futures are down, we have a CPI coming, you put 2 and 2 together, maybe market participants are going to read that as inflation peaking, and maybe the Fed will ease on raising interest rates. What does that do? That forces short covering. Understand this. When you long stocks, you can buy these stocks and stay on them forever until you die. But if you're shorting stocks, at some point you got to book your profits by buying the underlying stock. You can't just sit on the short position forever. Otherwise, you're going to lose your money. So when we have such a catalyst for short covering, all the shorts look around. Anybody's going to cover here? Are you going to cover? How about you? And then one of these shorts pulls the trigger and initiates a tsunami of short covering. Now, it is standard procedure for professional shorts, at least, when they start covering their shorts to buy call options on the underlying stock. That way, they can make more money as they exit the position. Now, what happens in the next step? We see the gamma squeeze, all of these shorts buying call options out of the money, and then we see options traders joining them on buying call options out of the money. What happens when we have a stampede in buying call options out of the money? The market maker who's selling these calls, writing these calls, well, they have to hedge. Otherwise, they might lose a lot of money if these stocks shoot up higher and these contracts become in the money. So to hedge, the market maker buys the stock. You see, buying call options doesn't move stocks higher. What moves stocks higher is the fact that the market maker is buying the underlying stock as a hedge, and that produces the gamma squeeze. When the gamma squeeze happens, we start to see certain technical indicators being hit. For example, in this case, the 50 days moving average, the SPY, in this case, the SPX, the cash index. And again, in my practice, I don't use moving averages at all. They mean nothing to me at all, but they mean something for the algos and the quant funds. So when you have the 50 days moving average being broken and then retested and the chart bounces higher from the retest, the quant funds automatically, they start buying stocks, and that produces another leg higher in the rally. And then what happens? Then the retail crowd, the Johnny-come-latelys, they feel the FOMO that they're missing out. This is the bottom. It's already here. The bears were wrong, yada, yada, yada. And they join and buy stocks. But here's the problem. Why do bear market rallies fade away in an aggressive fashion? The answer is, number one, remember the shorts, the bears, who covered their shorts and initiated the rally? Well, now that these stocks blasted higher, in certain cases by over 100% in a short amount of time, now the same bears, the same shorts, look at the action as an opportunity to re-short once again. And indeed, they place bets in re-shorting the same stocks. Immediately, we saw a lot of shorting in the euro dollar. We saw a lot of put options buying, and the VIX moved higher, indicating that these shorts are re-shorting once again. Now, what happens to the gamma squeeze, perhaps the most important part of any bear market rally? The answer is there is a time limit. There's a deadline for the gamma squeeze. If the market maker decides to dump, they dump, and they end the gamma squeeze. It's done. And this is exactly what happened on August 19th, about 2 weeks ago. It was options expiration. About $2 trillion worth of stock options were due to expire. Here's what happened. At issue is the belief that derivatives markets have somehow played a key role in suppressing volatility, thereby compelling rules-based quant traders to buy shares and in turn luring a broader group of investors back in the stock market in order to chase gains. Stocks have restored roughly $7 trillion in value since mid-June, as what began as a short squeeze cascaded into a buying spree by those who exited equities during the first half carnage, amid fears that the Fed's aggressive inflation fighting campaign could tip the economy into a recession. Shares have since recovered as data showed a robust labor market and cooler than expected inflation. Along the way, traders flocked to call options to catch up with the surprising rebound. In balancing their books, options dealers were stuck in long gamma quote-unquote positions that left them needing to go against the prevailing equity trend to maintain a neutral market exposure, meaning they have to buy the underlying stock because they wrote call options on it. Thanks in part to the process, peace returned in the market. The CBOE Volatility Index, or the VIX, has averaged 21 in August, on course for its lowest level since November. Then what happened? Traders will try to push the S&P 500 toward 4,300. Mind you, this is August 19th, in order to get their options contracts to pay off. Listen to this carefully. Any failure to hit this threshold would suggest that the latest rally is losing momentum, potentially inviting sellers. What happened on August 13th? The SPY S&P 500 failed at the 200 days moving average and did not make it above 4,300. Why? Because the market maker decided to dump. The market maker is not stupid. They know that the Fed is not bluffing, at least for now. They know that the rally has no legitimate legs at all. So they decided to dump their stocks, the underlying stocks, and make all of these call options expire out of the money. Hence, the gamma squeeze ended. So what do we have left when the bears are reshorting once again? When the gamma squeeze is done, who's left here? We have the retail investors. They happen to be the last to join and the last to get out. They will get out after we're already at the June bottom, if it happens that way. Now, what about the quant funds? Are they going to rush to the rescue and reignite the rally again? No, they're not. They're guided via the technicals. And the moment the 50 days moving average is violated, you're going to see all these quant funds dumping their positions once again. So who's left here? The retail crowd, who already got massacred in a short amount of time? Maybe more delusion will keep the rally going? I don't see it. And that's the problem here. What will it take for the rally to reignite and we see a move higher again? Do we have any catalyst in the horizon from a fundamental perspective, let's say inflation or Fed policy, that could change the sentiment once again to become bullish? The answer is not anything that I can see right now. We have the CPI, that's in September. We have the employment report this Friday. That could be a catalyst. But besides that, unfortunately for the bulls, the law of gravity will take place here. And this is how bear market rallies are born. And this is how bear market rallies end. Next, I want to talk about the inflation cycle. And I know this is going to be a long video, but hey, you're paying for it, so sit down and relax. While I was away, all what I heard on TV and from other managers is, oh, the Fed is going to do this, the Fed is not going to do that, the Fed maybe is going to go in this direction or that direction, maybe it's going to take them a year to take inflation down to 2%, maybe 2 years, maybe longer than that. All of this talk and speculation about what the Fed is going to do or not going to do. And I say, who cares? Who cares? The Fed is no longer in control. The Fed is a follower, not a leader. The Fed is not in the driver's seat. The Fed is in the passenger seat. Inflation is in the driver's seat. What does that mean? It means inflation went down for a month. The Fed might react and say, okay, we'll do 50 basis points instead of 75. Next thing you know, inflation moves higher again. And here comes the Fed chasing inflation, now being in the leadership position. And now they have to do 100 all of a sudden. This is the dangerous game that the Fed is playing. You see, Volcker, he was in the driver's seat. How did he get to the driver's seat? He did that by increasing interest rates above the CPI. He looked at inflation and said, I'm in charge here. I get to crush you, you move down, and then I chase you down. But you're not going to be in the driver's seat, and I'm going to make my moves accordingly based on what you're going to do. You're going to react based on what I'm going to do. You think Jerome Powell has even 1% of that set of balls? Of course not. So stop being fixated on what the Fed is going to do, what the Fed is not going to do. The Fed is a follower to the natural evolution of the inflation cycle. What is the inflation cycle, you might ask? Since everybody talks about, oh, it's a recession, it's stagflation, it's inflation. A lot of confusion out there. The natural evolution of any inflation cycle starts as inflation. You have the honeymoon period of inflation, wages rising higher, corporate earnings expanding, and then we hit the ugly stage of inflation when it becomes stagflation. Inflation moves too fast, too high, leaving wage growth falling behind. And we get stagflation, a phenomenon in which inflation remains high while the pace of economic activity slows down. And as that starts to work out in the economy, stagflation erodes the prospect of growth entirely from the economy, and the next step is a recession. Now, the trading strategies that we have, in inflation, we go long commodities. In stagflation, we go long consumer staples and utilities, and we short growth. In a recession, as we anticipate the recession, we short cyclicals, the reopening names, those kind of stocks. The Fed cannot change the trajectory of the natural evolution of the inflation cycle. The Fed can only extend or shorten a certain stage by their action. For example, we're now in stagflation. This is my assessment, of course. I'll give you the evidence in a second. But if the Fed decides to cut interest rates right now, what happens? We get an extension, a reignition of inflation. You're going to see commodities spiking higher again. Sooner or later, we're going to hit stagflation and then a recession. It's inevitable. There is no escape. And therefore, we say, once you got inflation, once you see the beginning of inflation, nip it in the bud. Because if you let inflation go, you're going to have to face stagflation and then the inevitable recession. Now, if the Fed over-tightens and becomes too hawkish, what happens? We skip right away to a recession. What if the Fed, let's say, just like Harker suggested, Governor Harker, who suggested that the Fed gets to 3.4%, maybe a little above that, and then sit for a while and watch what happens. A dumb strategy, of course, because what's going to happen is you're going to prolong stagflation, and sooner or later, you're going to hit a recession either way. And therefore, you might have noticed how the stock market reacts. Some days we see utilities and consumer staples leading. Other days we see technology leading. Sometimes we see commodities leading. Why do we see that in the stock market? The answer is because the market is trying to interpret what the Fed is going to do. They're trying to forecast what the Fed is going to do next. Are they going to be too hawkish by increasing interest rates aggressively and front load the recession? Are they going to bring back inflation by cutting rates? Are they going to prolong stagflation by sitting and doing nothing? And this lack of clarity by the Fed makes trading and investing in this stage of the stock market really, really challenging. But for now, the consensus, at least the way I see it, is stagflation. And here's the evidence. When we talk about stagflation, we have two parts. We have inflation that is supposed to be high or sticky at a higher level. And then we have the other part, which is economic activity slowing down. So let's see what we have here. You might have heard that PlayStation, Sony, they're raising prices by as much as 20%. Is this inflationary or not? Of course it is. We have inflation sky high across the country, regardless of the recent dip. The majority of the dip came from the Midwest and the Northeast. Wait till the winter season hits, and we have a resurgence of demand on natural gas and oil and all of that, and inflation could move higher again. And even as is, inflation remains way too high. But rest assured, next time you go to the pump and you pay here in California $5-6 a gallon, even after the dip, propaganda network CNN says think of it as $100 a month tax cut or $100 a month raise. We also have the lunacy and the delusion of the fiscal policy that is being absolutely out of control and absolutely reckless, which will cause more and more inflation. What are we talking about here? You might have heard recently that Joey B decided to forgive student loans, $10,000 each. $20,000 if you have Pell Grant. Now, before you start to say, hey, what do you have against forgiving student loans, but you're okay with giving money to the oligarchs? First of all, I'm not okay with giving money to the oligarchs. I attack that every single day. And frankly speaking, any country, be it the United States or otherwise, that places so many barriers to achieve education, that country is investing in its own self-destruction. Education of all things should be accessible, cheap, if not free. But of course, we have the midterms, the elections coming, and any politician, be it Biden or otherwise, would try somehow to bribe voters. And this is Joey B's attempt to bribe voters by forgiving some student loans. I don't think this is going to work because, number one, a lot of folks who paid their student loans will hold a grudge. Hey, what about me? What about the guys and gals who worked their tails off to pay their student loans? Meanwhile, we have, with a stroke of a pen, student loans being forgiven right now. What about us? That will backfire and alienate a huge group of voters. But regardless of that, economically speaking, is forgiving $10,000 each in student loans inflationary or not? The answer is it is inflationary. It will cost $300 billion. That's inflation. That's more spending. And it's not just me saying that, by the way. It's even Jason Furman, the top propagandist. He also says that this is a bad idea. It's going to cause more and more inflation. On top of that, when we talk about the lunacy of the fiscal policy, you have states like California now saying by 2035, we're not going to have any gas-powered vehicles. Everything is going to be EVs. Okay, are the EVs going to drop from the sky, or do we have to make them? And does this policy increases demand on EVs or not? The answer is it increases demand for EVs, and that causes prices to move higher. On top of that, the so-called Inflation Reduction Act will give you about $7,500 in tax credits if you buy an EV, of a certain price, of course. What does that do? In essence, it moves the price down, and that causes aggregate demand to kick in, so demand increases. And as a result, the tax credit gets canceled, because manufacturers have to raise prices. I'm not making that up. Ford, for example, raising the price of the Mustang Mach-E by as much as $8,475 due to significant battery cost increases. So the tax credits, down the toilet. More waste and more abuse of taxpayer money and causing more and more and more inflation. On top of that, what about the $3 to $5 billion that we send to Ukraine, it seems, every single week now? Where does that money come from? It certainly doesn't rain from the sky. Somebody has to print the money and increase spending, which is inflationary. And by the way, nobody knows where the weapons really go. There's a lot of corruption and fraud in the contracts. It's a whole other mess over there. But so far, we talked about the inflation side of stagflation. What about the slowdown in the pace of economic activity? How about this? The Small Business Confidence Index is at all-time low. According to the survey, about 28% of the respondents say that they will see revenue decreases in the outlook. What does that mean? They're not going to invest more. They're not going to buy more goods and stuff because they see a recession and a slowdown coming. And that in itself becomes a self-fulfilling prophecy. 77% of those small businesses say that inflation will continue to rise in the future. So they say revenues will go down, the pace of economic activity will go down, but inflation will stick higher. What else? How about the epic disaster from the New York Fed's manufacturing survey? What a shocker. A collapse in that particular indicator. Does this indicate an economy that is expanding or an economy that is contracting? The answer is clear. On top of that, the U.S. Global Flash PMI also moved into contraction territory. So we are seeing the pace of economic activity moving down significantly. According to the Global Flash U.S. Services PMI, it came out at 44.1 in August, down from 47.3 in July. That indicates a further reduction in overall services activity. The decrease in business activity was sharp overall and the fastest since May 2020. Service providers noted that hikes in interest rates and inflation dampened customer spending as disposable incomes were squeezed. Driving the fall in output was a renewed decline in new business. New orders contracted at the steepest pace for over 2 years. As companies highlighted greater client hesitancy in placing new work. Listen to this. At the same time, new business from abroad decreased at the second fastest rate since December 2020. In line with a sharper fall in backlogs of work, service sector firms recorded a slower rise in employment during August. The level of outstanding business decreased at the quickest rate since May 2020, with reduced pressure and capacity resulting in the softest expansion in service sector workforce numbers in 2022, I should say. Meanwhile, listen to this. Input costs continued to rise markedly. Although the rate of input price inflation eased to the slowest for 7 months, firms noted that wage pressures, transportation surcharges, and greater supplier costs have pushed up business expenses. So far, we've been talking about business activities slowing down, yet prices continue to be higher. These are the input costs for the manufacturers and the providers of these services. But listen to this. This is really important. In an effort to encourage new sales, output charges rose at the softest pace in 17 months. Despite being robust in the context of the series history, firms stated that greater competition had led to the moderation in selling price inflation. So this part talks about margins going down. They're paying more for the input cost, but they cannot charge more because the consumer doesn't have the disposable income they used to have. But somehow we're going to have a soft landing, right? And of course, the next step is a recession. And we continue to see the yield curve inversion deepening by the day. This is not a good sign. And nearly all investors, corporate executives, entrepreneurs, they all see a recession next year. According to Bank of America, the survey for fund managers suggests that we have the highest level of fund managers saying we're going to have a likelihood of a recession since April 2020 and March 2009. I wonder what happened back then in these two occasions. The fund managers were right, and they're going to be right again in their expectations of a recession. And that leads me to the last part of this segment. What argument do the bulls have left? The answer is they have the argument of the strong consumer, number one. Number two, low unemployment. Number three, peak inflation. Let's crush each one of these arguments using the facts and the data. Now, I talked about the myth of the so-called strong consumer in the previous video, and I showed you that AT&T CEO said that the consumer is not paying their phone bills anymore. They cannot afford to do so. And now we have even more alarming evidence. Believe it or not, younger people are not investing in the stock market anymore, and the reason is they don't have the money. They're spending their money in rents, utilities, grocery store, childcare. All of that is eating their savings away. On top of that, we got the stunning, absolutely shocking headline that we have 20 million US homes that are behind on their energy bills. They're not paying their bills. Is this the strong consumer who cannot even pay their utility bills? And what's going to happen from this point on? Are we going to see shutdowns of heat, for example, in the middle of the winter season? And now, after forgiving student loans, the consumer has the comfort that they can continue to spend and borrow and use their credit cards, and somehow the government will bail them out. And it's not just in the US, by the way. The crisis in the United States actually pales in comparison with the crisis over in Europe and the United Kingdom, where the prices of electricity and heat are absolutely skyrocketing in an insane fashion. When the European consumer falls apart, what happens to our companies' earnings? Are they going to still be intact? Or are they going to go down? And when earnings go down, what are companies to do? They're going to get rid of employees. But keep believing in the myth of the strong consumer. Even though last week we saw Nordstrom, the stock of that company, crashing because they said even their discount stores, Nordstrom Rack, they're not seeing consumers anymore. Nobody's buying anymore, despite the discounts, because the consumer is busy spending on gas, rents, mortgages, car loan payments, utility bills. They cannot afford to splurge anymore. So again, where is the strong consumer? I don't see it. You mean the strong consumer who's using credit cards out of whack, out of control, taking a lot of risk than they can really afford? What happens when they lose their jobs? You think Joey B is going to pay your credit card bills too? Think again. The consumer that you say is strong and will save the economy and prevent the recession is actually being squeezed. Mortgage payments are surging. Rents are surging. That will take away the purchasing power from the consumer. Restaurants will see less patrons. Businesses will see less business. Travel companies will see less travelers. And this is how the recession happens. There is no such thing as a strong consumer. The consumer is getting absolutely annihilated in this economy. What else in the bull's argument? Well, they say low unemployment. The jobs market remains hot. How could you have a recession when you have such low unemployment? I'm not sure if you're aware or not, but the majority of the so-called jobs created in the economy were actually jobs recovered in the leisure and hospitality sector of the economy. They got rid of the jobs during the lockdowns. Now they got the same employees back. The only difference is they got them back at inflationary wages. And so long as they can increase their prices higher, we're talking about airlines, cruises, hotels, so far so good. But the moment consumer spending starts to weaken, all of a sudden these companies will find themselves in a hole. They cannot continue to maintain paying these inflationary wages when the consumer is spending less in their businesses. They have to get rid of these employees once again. What are we seeing right now among consumers? Well, spending in airlines and spending in lodging moved down significantly in the month of July, and the trend looks like as it's going down, as if consumer spending in airlines and lodging has already peaked. And that means that the next step is these companies laying off employees. We will look at consumer spending, at least among the higher income. They have all reduced spending dramatically in the month of July when we talk about airlines, lodging, leisure. And we're already seeing layoffs, folks. Look at Peloton, Calm, LinkedIn. All of these trash companies hired all of these people at inflationary wages they cannot really sustain. So now they're getting rid of employees. Even larger companies, such as Ford, they announced getting rid of 8,000 jobs a few weeks ago. Now they're getting rid of about 3,000 additional jobs. The wreckage among tech startups is absolutely stunning. So far in 2022, tech startups layoffs are approaching 71,000 jobs. And even in Facebook, aka Meta, Mark Zuckerberg, he's firing people using algorithms because he doesn't want to make eye contact with you when he says, hey buddy, you lost your job, you're fired. But I'm not going to make lizard eye contact with you. It's the algorithms, not my fault. And how bad will it get when we talk about unemployment? Look at this. This might be a little complicated to look at, but on the y-axis we have the jobs openings rate. On the x-axis we have the unemployment rate. So far, so good. We have two models. In dark blue, we have the Waller model, which is bullshit. And then we have the historical curve estimate in the light blue. Right now, as you can see from the red marking, job openings at around 6.5%. And the unemployment rate correlates with that at around 3.5%. If the Fed wants to get rid of the excess in job openings and move that rate down to the pre-pandemic level, according to the Waller model, that will correlate with an unemployment level of around 4.5%, which is the soft landing that the Fed was selling us until they stopped. Because according to the historical curve estimate, if we use that model to get the job openings rate down to the pre-pandemic rate, the unemployment rate has to go above 6%. In other words, the unemployment rate has to approximately double before we see the excess in the jobs market gone, at least if this is what the Fed is looking for to tackle inflation. So now that we've dismantled the bull's argument of the strong consumer and low unemployment, which is, by the way, a lagging indicator, we see unemployment rising higher as the recession taking place, not before. Unemployment is a symptom of the recession, not the cause. The last point that the bulls have is peak inflation. Gasoline futures are down, crude oil futures are down, which means peak inflation, and the Fed has to ease the monetary policy, not tighten. Here's the problem with all of that. Crude oil futures went down because traders assumed that the Fed is serious about tackling inflation when they raised interest rates by 75 basis points. I did the same in my fund. We dumped oil futures altogether because we don't want to fight the Fed. But at any hint that the Fed is wavering, we will go right back in buying oil futures because the fundamentals remain intact. What are we talking about here? Look at the fuel supplies in the East Coast, for example. They're at historic lows, meaning the demand is surging. That supports higher prices. Exports of crude oil and natural gas from the United States are surging higher due to the Russia-Ukraine war. We have European demand on top of the domestic demand. That means higher prices to come. Likewise, when we talk about natural gas, we only got a dip in natural gas last week after getting news that the Freeport LNG facility will be delayed once again. But sooner or later, the Freeport facility will be restarted. The demand from the European consumer will not go away. It's actually going to increase in the winter season, which means higher natural gas prices. On top of that, we got a massive fire in one of the largest refineries in the United States, owned by BP, that reduces supply while demand remains hot, at least for now. So the fundamentals for higher oil prices are here. Thus, the assumption, the premature assumption that inflation has peaked has absolutely no legs to stand on. And there you go, folks. We talked about fighting the Fed. We talked about the cycle of a bear market rally. We talked about the cycle of inflation. And then we dismantled the bull's argument one by one. So I hope you're getting a good bang for your buck so far. But wait. There is more. We're not even done yet. We're done with the In Focus segment, the macro segment. Let's move on to the technical/stock market segment. We start with the closing of the indices today, and here we go. The Dow Industrial Average attempted to rally today, but it finished down by 184.41 points, or a decline of 0.57%. The Nasdaq down by 124.04 points, or a decline of 1.02%. The S&P 500 down by 27.05 points, or a decline of 0.67%. The sector's performances led by number one, capturing the gold, the silver, and the bronze. Energy, because utilities, that was pathetic compared to the outperformance of energy today. Of course, coming at the bottom, the laggards, technology, real estate, and materials. The advance to decline ratio, NYSE 48% advancing versus 50% declining. The Nasdaq 37% advancing versus 60% declining. And it could get a lot worse, folks, in coming days. Moving on to futures, we start with energy. The story of the day, of course, the massive rally in crude oil futures, the WTI and Brent, both scoring gains of about 4% for the day. Once again, 4% for the day. Peak inflation, you say. While the gasoline RBOB was up by about 1.5% and natural gas pretty much flat for the day, but on the heels of a massive rally in the last few weeks. What about softs? OJ leading the pack with about 3% worth of gains, followed by cocoa, which closed in the green with about 0.5 percentage point gains. The rest closing in the red, led by lumber, which lost about 1% today. Coffee, cotton, sugar, all in the red. We're going to talk about details on cotton futures tomorrow because I don't have time right now. What about metals? And again, metals are indicators of the economic cycle, specifically copper. Copper rises higher in anticipation of an economic boom. Copper crashes, moves down in anticipation of a recession. Copper leading the declines today, losing yet another 2% or so of its value. But we saw silver down. On the other hand, palladium, gold, platinum, pretty much in the flat line. What about meats? Gains led by the new big tech lean hogs. Scoring gains of about 1.75%, yet we have live and feeder cattle futures lagging for the day. Feeder cattle lost about 1.25% today. Lastly, grains. Look at that. Wheat surging higher, scoring gains of about 4.5%. So when you say peak inflation, all what I'm seeing right now is crude oil futures bottoming, certain grains bottoming, such as wheat and corn. Corn, by the way, a massive rally as of late, and added yet 2.25% worth of gains today alone. The laggard is soybeans. Soybean futures were down by over 4%. I'm going to talk about the details in tomorrow's video because I don't have time right now. Moving on to the big casino, the options market, what's going on here? The volume disappeared, a complete contrast from the last few weeks because the gamma squeeze is over. And this is yet another indicator that is troubling for the bulls who are betting that the rally will reignite somehow. It's not going to happen without participation of buying call options specifically. What we're seeing right now is options volumes moving down, and we're seeing more buying of puts versus calls. But regardless, here it is at number one. The hottest table by far, Apple, at around 1 million contracts traded today. About 51% of those were calls. And at number two, Tesla, the souffle, the split, not helping here. It's actually helping bears to buy cheap options. They're not really cheap, by the way, just so you understand. Just because the price is down, you're not getting a good bang for the buck because the premiums are still too high. For example, we take about 5 to 6% worth of a move if you're buying call or put options on the money when you're trading Tesla versus maybe a move worth 1 to 2% in any other stock. So while the value of the numeric number is low, it's still not a good deal because we take a sizable move by the stock for these contracts to be in the money. Anyhow, Tesla at number two at around 750,000 contracts traded today. About 51% of those were calls. And at number three, Triple BY, Bed Bath & Beyond. The mania is here once again. Perhaps they're waiting for the Grand Master Plan on Friday. The revival of Bed Bath & Beyond, which is yet another phase of the pump and dump scheme. Anywho, the name traded about 650,000 contracts today. About 70% of those were calls. No wonder why Bed Bath & Beyond was higher. Similar story with AMC at the bottom of the table. About 80% of the options traded for that name today were calls. So these names are moving higher. This is an attempt by the retail crowd to reignite the rally in these stocks. And then we have 3M. 3M is down big for reasons we're going to discuss perhaps in tomorrow's video, but we're seeing more activities in 3M options. They're appreciating in value big time. It was one of the names that I suggested you short about 2 weeks ago, and these put options are printing money like crazy. But perhaps the opportunity is in the opposite trade this time around. Why? Because when we look at the implied volatility for 3M, it is surging higher. The IV percentage is at 99%, meaning the current volatility in 3M is higher than 99% of days in the last year or so, meaning the premiums are way too high. Well, the stock has been moving down, not up, so the put options in this name are extremely expensive. So to take opportunity of all of that, I'm selling these puts in a credit spread out of the money. I don't think the stock will go down further in an aggressive fashion. And even if it does, the premiums are so high that the chances of profitability from the trade are way too high. Certainly way too high to ignore. Anyhow, moving on to the unusual activities that took place in the options market today. Boring. Nothing at all, yet another indicator that the mania is gone. They're now buying some contracts here and there with 4 days till expiration, 7 days till expiration, few cents here and there, nothing major, nothing with conviction. But I'm going to read some of those for you anyways. We start with the ticker NKLA Nikola. Somebody bought the $5 puts. The name went higher recently based on the EV credits and all that crap. But somebody's betting that all of that's going to frizzle out. They bought the $5 puts for the expiration date, November 18th, with expectations that the name could move down by more than 16% by then. They paid about 70 cents a piece to enter this trade, all in all spending around $4 million. And then we have the ticker EEM for emerging markets. This is the ETF. Lots of call options buying on the EM today. Perhaps investors are seeing opportunities overseas. In any case, somebody bought the 43.5 calls for the expiration date, September 16th, with expectations that the name could move higher by more than 9.5% by then. They paid around $1 a piece to enter this trade, all in all spending around $1.5 million. And lastly, what about the ticker TAL? This is for TAL Education. The name is down, 99% since the top? But all of these Chinese names moved higher recently. On the rumor that we have a deal with the SEC, on the rumor that we have more easing in China. It's not actually a rumor, it's a fact. They're easing the monetary policy versus here in the United States, we're tightening. So perhaps investors are chasing where the policy is easy, and that is China. Now, TAL moved really high, impulsively so, in the last few days. Somebody's buying calls, betting that this gamma squeeze, short squeeze, whatever it is, will continue. I would actually take the opposite side of this trade and buy puts with a longer expiration date. But anyhow, for this trade, somebody bought the $8 calls for the expiration date, September 16th, with expectations that TAL could move higher and score gains of over 22% by then. They paid around 45 cents a piece to enter this trade, all in all spending around $450,000. Moving on to the heat map analysis, what do we see here? What is the theme from today? Certainly not offensive, certainly not risk on. We're seeing technology down, chips down, the cyclicals, reopening names, airlines all down, communication services down, but even the defensives in big pharma were down big today. What's working is the inflation theme of oil and gas, and then you have the stagflation theme that we talked about earlier in the video of utilities and certain consumer staples. In this case, the name that I have is GIS, General Mills. We talked about this name before. It remains an outperformer. This theme will change day to day based on how we see the outlook for the economy. If we see more inflation, we're going to see energy moving higher. If we see more stagflation, we're going to see utilities and the consumer staples moving higher. So how do we know, Maverick? What do we do here? What is the sustainable theme? Well, we know that the Fed will continue to tighten. We know the economy is slowing down. What we know for sure is we have weakness in technology, the high growth, high momentum kind of names. So the rips in these names have to be shorted, fade the rip, at least for now, because we don't have any data that supports buying growth and technology right now. None whatsoever. And the valuations, by the way, despite what you hear on TV, still not attractive. So for now, we're sticking with some energy names. I'm going to talk about it in the charts analysis. We're sticking with certain consumer defensives, the likes of Hershey's and General Mills, for example. We're sticking with certain defense contractors, in my case, Lockheed Martin, and I will talk about more tailwinds for this name in tomorrow's video. And I'm sticking with certain utilities. These tend to outperform when we have stagflation. But besides that, everything else is risky. Moving on to the heat map for the ETFs, what do we see here? Obviously, the outperformer energy ETFs, XOP, XLE, OIH, USO, all blasting higher. But today was a good day for uranium. URA was exploding higher. We have good news about nuclear facilities in Europe and the use of nuclear energy. That is pushing uranium stocks higher. But besides these two, we have in international, the EWZ, the Commodities giant Brazilian ETF. But besides that, everything else is down. Whether we're talking about chips, whether we're talking about tech, whether we're talking about growth, value, mid cap, small cap, large cap, financials, it doesn't matter. They're all down. This is a defensive theme suggesting that if we don't see the next few days an attempt of a rescue, we will see more pain to come. And with that lovely note out of the way, let's move on to charts and see how big of a pain we might get. We start with SPY, the S&P 500 30 minutes chart. What's going on here? We got the gap down in the morning. There was an attempt to reclimb the resistance at around 405. That did not work out. But what happened? The gap was closed, but the chart did not close above the gap. It appears that it failed to get above 405. Reading the chart as is right now suggests more pain to come. Unless the chart can make it above 405 early on tomorrow, then the bulls got a shot in a repair work. At least working at the 15 minutes, the 30 minutes kind of charts. But if we continue to go down, how bad is it going to be? Well, we have to zoom out and we have the next support at around 398. And then after that, we have 393.16. If we get there, might as well go down to closing the gap. As you can see, the chart is eyeing a destination here. It told us today it's not ready to cross above 405. Is there any piece of economic data, a catalyst somehow that we can get tomorrow that could get us above 405? Perhaps. But absent of that, for now, the trajectory is down we go. We have to find support, and by finding support, we mean finding buyers. The buyers were here today, but there were not enough of them to get us above the 405 really important resistance, which the bulls are hoping to turn into support once again. Can we find more buyers at 398? Perhaps. If not, we're going to continue to go down until we find buyers. And here's the daily chart for the continuous contract for the SPY S&P 500. Folks, every time we have a chart with a consolidation range, a defined support, defined resistance, and then we have a false breakout one way or the other, usually we see a violent breakout in the opposite direction. A famous example of all of that is the chart of Netflix and Amazon. We covered those in details in this channel. Likewise, in this chart, we got the false breakout out of the consolidation range, and now we're having the actual break Unfortunately for the bulls, it is a breakdown, and it's a violent one. It's a flush down. And we're now looking at the support of around 3,960. Could there be a reattempt in climbing the consolidation zone? Yes, there could, but it's going to be met with failure once again. Why? The volume moved higher and it continues to move higher on downside activities. We have a confirmation from the MACD indicator that the bullish momentum is over and we have a new bearish momentum. The RSI is showing negative divergence. All of these are indicators that we're not through with the downside yet. When we look at the SPX, the cash index, this is a weekly chart. Of course, the most broadcasted resistance in history and reversal perhaps in history was the sloping line of resistance that everybody talked about, including in this channel. Well, guess what? The chart hit it to the penny and it moved down. It lost an important Fibonacci support. Now we have the most important support at 3,800. The assumption for now is we're going to go down to visit that number. Is it going to happen tomorrow? Is it going to happen next week? I don't know. But it's going to happen because after such a shock, we need to find reliable support. You're not going to find it between. What you're going to find between is the leftover gamblers and the retail crowd who believe that now they're getting the pullback that will give them the opportunity of catching the rally that they missed, perhaps. I personally will continue to hold on shorts all the way till we get to 3,800. If there is a legitimate rebound with volume, with conviction, then I'll take some profits. And then we'll talk about if we have a rebound and a move higher again, and perhaps the formation of a reverse head and shoulder formation. But until then, you can't buy the dip here. This is not a good way to buy the dip. We have to find a legitimate support. And that would be a downside of another 5% or so in the SPX, the cash index. What about the Qs? 30 minutes chart. What's going on here? Unlike the SPY, there was notable weakness in the Qs. A, the chart did not close the gap. B, it did not even attempt to climb above the last resistance / support at 308.55. It is now forming a bear flag formation, indicating that perhaps the chart wants to go down further. It wants to seek another support. It is eyeing a certain destination. The obvious one is the round number of 300. If that doesn't work out, then we have to close the gap all the way down at 294.33. If there is a pop, a rescue operation in the morning tomorrow, it will happen due to oversold conditions. So absent of a fundamental catalyst, if you see the chart moving higher tomorrow, it will be due to oversold conditions. Once that's repaired, the chart will resume the move to the downside. And here's the daily chart for the continuous contract for the NASDAQ. Look at that. It hit the resistance pretty much to the penny, a hair above 13,600. This is a trend line. If you zoom out, it goes all the way back since 2020. It was support. Now it acted as resistance. Since then, the chart moved down significantly. It lost a lot of support. Now it is seeking buyers at a reliable level of support. Number one, we have the trend line in yellow. If that's broken, that would be bad. But even if that happens, we have 12,207. You can round that to 12,200. Doesn't matter to me. But if that's broken, we have a problem. If that's broken, we have to talk about revisiting the June bottom. For now, the volume is moving higher on downside activities. We have a negative divergence on the RSI. We have a confirmation in the MACD indicator of negative momentum. All of these are indicators that we're not through with the selling yet. And what about the IWM, the Russell 2000 small caps, 30 minutes chart? What's going on here? A big drop since the recent top. The chart attempted to go all the way to close the gap. It did close the gap, but it did not rally from that point on. It did not close the day above the gap. This is bearish, not bullish. It would have been bullish if the chart closed the day above the gap. Then we would have been talking about a relief rally that could take the chart all the way to 191.5. to take another crack at climbing 191.5. If we have a pop tomorrow, it will be due to oversold conditions. That is not a reliable bounce. Otherwise, the chart has further downside to come. If that is the case, we have to zoom out. We don't have a lot of reliable support, by the way, and this is a big problem for the IWM. We have soft support at 182.81. We have another soft support at around 178.60. And we say soft support because it hasn't been retested reliably so many times. It comes from previous gaps. But the most reliable support we have is 174.22. The chart is now at 187.24. That would be a steep drop, a flush down if it goes all the way down to 174.22. For now, my outlook is after unwinding such a steep rally in a short amount of time, we haven't seen the end of the selling yet. It will take us one way or the other all the way down to 174.22. The Dixie, the dollar index, the daily chart, what's going on here? After the CPI, everybody assumed that the dollar would go down. And indeed it went down, but it rebounded and closed above the lows. At the time, I told you that I'm smelling a trap here. I believe the dollar is going to bounce higher again. And since that time, indeed it did, it rallied significantly all the way back to the resistance, which if you will recall, if we zoom out to a monthly chart, for example, this is a trend line that goes all the way back since the 1980s. So it is significant resistance, and the chart is having a hard time breaking above that line. It tried once, twice, this is the third attempt. And if third time is the charm, guess what's going to happen after breaking above such resilient resistance? A massive pop, a massive surge in the US dollar. This will not be good for stocks. Certainly not good for gold. Look at gold. Last week, there was an attempt by the chart to reclimb 1,763, turning that into support once again. That did not work out. We have a rejection now. So if you had to guess, will gold crack above the resistance of 1,763, or the most likely scenario is for the chart to go down, seeking support at 1,685 first? I would go with seeking support, but it all depends on the dollar. If the dollar doesn't make it above the sloping line of resistance, then we will see gold popping higher again. And what about oil? Brent oil, 4 hours chart. What's going on here? We have a saucer bottoming formation. We know in these saucer bottoming formations, at the end of these, we get a blast higher, an impulsive pop higher. Perhaps this is what we got today, and the chart faced some resistance at around 105.84. It came short. It is becoming overbought in the 4 hours chart at least, and oil bulls should be hoping that the chart will close above 105.84, turning that into support from resistance, and then the chart can work out these overbought conditions, via consolidation. But so long as it is trading above 105.84, that would be super bullish, indicating another pop coming for crude futures. But if the chart pulls down aggressively without reaching 105.84 support, that would be a problem, at least for oil bulls. And here's the daily chart for the 10-year yield. What's going on here? We're back above 3%. The momentum indicators, the RSI, the MACD, all suggesting more gains to come in the 10-year. Unless we see a break of the support of 3%, the trajectory is higher for the 10-year yield. And what about the TLT? This is a weekly chart. For now, the TLT is forming what it appears to be a higher low. And at some point, we will see the yield curve inverting further, which means the TLT should move higher. When will that happen? I don't know. But for now, if we're looking at the 10-year yield moving higher, we shouldn't be looking at the TLT moving higher. The problem for the TLT bulls is if this trend line is broken, then we're going to look back again at 109.5. If that's broken, then that will unleash another wave of selling in the TLT. What about the VIX 4 hours chart? What's going on here? Look at the MACD indicator. We have bullish momentum right now. Yes, it is getting a little overextended, but we got an ABC pattern. And who's to say that what we're seeing right now is yet another ABC pattern that could take us all the way to the 30s in the VIX. That could happen really fast. If we zoom out to a daily chart, we don't have two ABC patterns. We have one. The VIX, look at the MACD indicator, has been in bearish momentum since June, the so-called June bottom in the stock market. All of that energy is now being released impulsively so to the upside in the VIX. And hand in hand, we're seeing a flush down in the indexes. SPY, the Qs all moving down. Look at the MACD indicator from a daily chart perspective. Look at the RSI. Look at the ABC pattern. You think it's done? You think this is it? This is the pop we're going to get in the VIX? I doubt it. I think you're going to see a 30-plus reading in the VIX pretty soon. What about Apple, the daily chart? What's going on here? We have a confirmation in the MACD. Once you see these red candles on the histogram, you know we have a confirmation that the bullish momentum is over, and now we have bearish momentum. We have the support of the trend line in yellow. That will be support number 1. Then we have support at 157. But the chart looks bad right now because we have negative divergence on both the RSI and the MACD, indicating that we could go down further. 157 is the number that I'm eyeing. If it's broken, we will see it another flush down all the way to 150. And you could have seen the confirmation from the weekly chart perspective. As you can see, we have a reversal candle followed by a confirmation. So what are we going to see? We're going to see more selling to come, regardless of the bounces and the dip buying. And the Fibonacci support is at 153. This is from a weekly chart perspective. If that fails, we're going to go down all the way to 134. But we'll take it one step at a time because we have a note from Bank of America of a potential of a reverse head and shoulder formation in Apple, and that will happen from either 157 or 150. But if the chart breaks 150 as support, the head and shoulder, reverse head and shoulder, I should say, goes out of the window. Therefore, 150 is a critical support, and it should act as such, producing a bounce at least. But if it is broken, it's going to do the opposite thing. It's going to open a sinkhole of more selling in the stock. And the way I see it is not a reverse head and shoulder at all. What I see is a trend line combined with a sloping line of resistance. This is a weekly chart still. Apple got rejected from the sloping line of resistance, and now it has already broken the support line. Can you say that this is bullish? Of course not. What about Tesla, the souffle? What's going on here? This is an hourly chart. One way you can look at it is a double top. Another way you can look at it is a saucer top with defined lower lows as resistance, and we have support at 280. Now, if that support is broken, the chart goes down to close the gap at around 258.79. If that support is broken, there's another gap below at around 248.71. If we zoom in a little more, what if this is a beginning of an ABC pattern? We got the A leg, followed by the B leg, the rebound from 280, and then we're going to see the C leg after re-breaking the 280 once again. It goes all the way to 258.79. This is the bearish outlook, of course. What about the bullish outlook? The bullish outlook relies on the daily chart. Tesla bulls would argue that this is a cup and handle formation. Sooner or later, the chart will go all the way higher in a retest to the top range of the channel. All of that goes out of the window the moment Tesla breaks 258.79 as support. So 280 is critical for the bulls, but even if they lose that, it's not a big deal because we have 258.79. But if they lose that, the bears should be doubling down because we will see more pain to come. Here's the 4 hours chart of Bitcoin. What's going on here? We have a trend line that has been broken, followed by a series of bear flags, one after the other, all played out until the chart got really oversold. And now we got a rebound. The chart is peeking its head above 20,000. I don't feel safe here buying the dip at all. I don't see any reason to buy the dip right now. If anything, I see an oversold bounce, which will be followed by another break of 20,000 to the downside and a re-acceleration of the losses. Something gonna happen here. A rescue of some sort. And here's some bonus charts for you. I talked about adding Coterra once again to my longs and adding HR block to my shorts. Let's start with the ticker HRB for HR block. An impulsive rally higher, short covering, gamma squeeze, doesn't matter. But from a weekly chart perspective, we have the Fibonacci levels, and the chart should go down at a minimum in a revisit of Fibonacci support at around 40. Now, you cannot really trade options in this stock because they're not widely traded, so I did short the stock by borrowing shares. If we go down to 40, that would be a decent profit. But better yet, if the chart goes down all the way to the next Fibonacci support at around 34.5. We have a tailwind. The so-called Inflation Reduction Act has, $80 billion to the IRS? You think the American public will not be mad if they're not using the $80 billion to produce their own program and we have to pay Intuit and HR Block? Now, Intuit is down big. HR Block is blasting higher, way overvalued. So I see the opportunity of shorting the stock right now. I will look back at it in 2023. The stock will be down big. Next, we have CTRA Coterra. Let's go back and hear what I said about it last time, which is CTRA Coterra, a natural gas play. Forget about oil for now. Chevron, Exxon, Occidental. If you want to play rebound in energy, stick with natural gas. You got Coterra, you got LNG, Cheniere, you got EOG, you got a lot of names that we talked about before in this program. But this is the weekly chart of CTRA Coterra, which I used to own, but it has now become overbeaten, oversold, a massive decline since the top at around 35, 36. It appears for now that the chart is making a reverse head and shoulder formation. It appears that we have positive momentum in the MACD indicator. Now, if natural gas futures continue to rebound higher, we will see names like CTRA also rebounding higher. And here's the update. Since then, massive rally, decent gains, and I decided to convert my call options into stocks once again. And the reason is I see natural gas futures moving higher. I see the Freeport LNG facility coming back online either in September or October. That will produce more gains for natural gas and higher price for Coterra. You don't have to buy this one. You can buy EQT, you can buy Cheniere, it doesn't matter to me. But the bottom line is we're bidding for natural gas to move higher. The catalyst, the tailwinds, are all here. And I'm eyeing closing the gap at around 34.31. Next, I have the ticker SLB. Everybody's now looking at oil futures, perhaps bottoming and moving higher again. All of a sudden, we have a stampede to re-add these positions back into our portfolios. Instead of buying oil futures or ETFs, I'm looking at the gasoline RBOB. It's still down. On the other hand, we have crude oil futures moving higher. So a processor will be the right play here. They benefit from the lower prices of gasoline RBOB. Their input cost is down, but they can still charge higher prices because crude oil prices are moving higher. So I see an opportunity here in this weekly chart of SLB. It is maintaining the trend line. We have two targets here. Target number one, the top of the breakdown candle of around 45.32, and then closing the gap at around 47.21. If the chart reverses and it appears that it's going back to the trend line, I will exit the position right away. And therefore, I'm playing it via call options because I don't have a strong conviction in this one. And lastly, moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have more Fed zombies speaking. Tom Barkin, we talked about that one. We have John Williams. I would say Williams is more important because he used to be the king of the doves. So if we start talking hawkish, that would be a problem. We also have the S&P Case-Shiller Home Price Index. This is a lagging indicator, of course, but it is important. We have the Consumer Confidence Index, and we have the JOLTS, job openings and quits. This will be critically important because we talked about it in the macro part of this video, where job openings going to meet the unemployment rate. Anyhow, folks, this is all I got for you for now for this video. Apologies for the absence once again. You guys are extremely valuable to me. You mean the world to me. And I hope that this new direction that we're going in having a hybrid model of memberships/free videos, that's going to work for everybody, for me, for you, for those who are not subscribing, it doesn't matter. I hope that this works for everybody. And with that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.
Quick buck artists come and go with every bull market, but the steady players make it through the bear markets.